Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're tackling the ambitious housing target set by the Ontario government, 1.5 million new homes by 2031. Recent projections, however, seem to suggest that this goal is slipping further out of reach. Janine, what are your thoughts on these developments?
Steve, it's concerning to see that the latest budget projects sluggish construction activity over the next 3 years, with only 71,800 housing starts in 2025, 74,800 in 2026, and 82,500 in 2027. These numbers fall short of the pace needed to meet the target by a significant margin, and it makes me wonder about the impact on communities waiting for more affordable housing options.
Exactly, Janine. As of now, only 260,000 homes have been built since the goal was introduced. With the current projections, the province will only be about 1/4 of the way there by the end of 2026, which is halfway through the timeline. To close this gap, construction would need to more than double in the final 5 years, averaging over 218,000 housing starts per year. That's a steep climb.
And it's not just about numbers. Eric Lombardi, president of the housing advocacy group More Neighbours Toronto, criticized the measures in the budget as ineffective and claimed the government has given up on its own housing goals. It's disheartening to hear such criticism, as it reflects the frustration felt by communities who need these homes.
True, but the Ford government insists it remains committed. Finance Minister Peter Bethlenfalvy mentioned during a news conference that we're not going to relent on trying to achieve that goal. The budget includes some additional funding, like $400 million for municipal infrastructure and $50 million to boost modular housing capacity. But it seems these efforts aren't enough to bridge the gap.
It's interesting to note that the budget doesn't make changes to the province's main housing incentive program, the Building Faster Fund. Despite being designed to reward municipalities that meet annual housing start targets, it disbursed just $280 million out of a planned $1.2 billion in its first year, as many municipalities missed their 2023 targets. That lack of progress must be frustrating for local governments and residents alike.
Bethlenfalvy attributes the lower projections to global trade tensions and tariffs, which he says have impacted housing starts worldwide. However, it's worth noting that the construction slowdown began before these tariffs were reintroduced. The 2024 forecast called for 87,900 starts, but actual figures came in at 74,600. So there might be deeper issues at play here.
Indeed, and while Bethlenfalvy is hopeful for federal assistance under Prime Minister Mark Carney, it's crucial that provincial and federal governments collaborate effectively. The Ontario Real Estate Association has praised the budget's pro-housing measures, but Green Party leader Mike Schreiner criticized it for failing to address the housing affordability crisis. It's clear that opinions are divided on the effectiveness of these strategies.
In a recent legal case, several Ontario homebuyers took a stand against a developer's attempt to impose unexpected utility-related charges just before closing. The court sided with the buyers, ruling that the agreement of purchase and sale only allowed for certain utility costs paid directly to municipalities or utility providers, not to private contractors. Janine, this case seems to highlight the importance of understanding the fine print in purchase agreements.
Absolutely, Steve. It's a relief to see the court's decision favoring the buyers, especially when these surprise charges could have added tens of thousands of dollars to their costs. The buyers argued that the developer was trying to recover costs that should have been part of the overall infrastructure development, and the court agreed. This decision is a significant win for homebuyers, reinforcing the need for transparency in these agreements.
The developer's argument was that the term utility service providers included third-party contractors, not just municipalities or utility companies. However, the judge applied principles of contract interpretation, emphasizing the need to avoid unjust or unreasonable outcomes. The court found that the plain language of the agreement did not support the developer's position.
It's also worth noting that the court found the developer's actions amounted to bad faith, particularly because the statements of adjustments and certificates they provided were misleading. This case really underscores the importance of clear, honest communication between developers and buyers.
The court's decision also showed that the limitation of liability clause in the agreement, which the developer tried to use to limit the buyer's remedies, was not applicable. This was due to a public policy interest in preventing developers from escaping liability when they charge for unauthorized amounts. It's crucial for both parties to ensure that agreements are fair and transparent from the start.
This case serves as a reminder for homebuyers to thoroughly review the wording of their agreements and to seek legal advice if needed. The court's ruling provides a precedent that buyers have recourse when they believe a developer has added unauthorized charges. It's reassuring to know that the legal system can uphold fairness in these transactions.
Let's shift gears and talk about the recent developments in the bond market. Canadian 10-year bond yields have risen above 3.3% this May, reaching a 4-month high. This increase comes as investors digest mixed signals from the inflation report and face upward pressure from United States Treasury yields. Janine, what do you make of this situation?
Steve, it's quite interesting to see how Canada's inflation landscape is evolving. In April, the headline Consumer Price Index fell to 1.7% year-on-year, which is the lowest in 7 months. However, the Bank of Canada's trimmed mean core measure rose unexpectedly to 3.1%, marking its highest level in over a year. This divergence creates a complex scenario for the Bank of Canada, as it might need to maintain its restrictive policy stance for longer to keep real yields elevated.
Exactly, Janine. The situation becomes even more intricate when we consider external factors. The United States 10-year Treasury yield recently jumped to a 1-month high. This was after Moody's downgraded the U.S. sovereign credit to AAA1 on May 16th, sparking renewed concerns over fiscal sustainability. This downgrade has led to a broad increase in global sovereign yields, including Canada's.
That's right, Steve. It's a reminder of how interconnected global financial markets are. The U.S. downgrade and its ripple effects highlight the challenges that central banks face in navigating monetary policy amidst global economic uncertainties. For Canadian homeowners and potential buyers, these developments could mean higher borrowing costs if bond yields continue to rise.
Indeed, Janine. Higher bond yields often translate into higher mortgage rates, which can impact affordability for many Canadians. It's crucial for those in the housing market to stay informed and possibly consult with financial advisors to understand how these changes could affect their financial planning and mortgage options.
Absolutely, Steve. While the numbers are important, it's also about understanding the broader implications for everyday Canadians. As these economic factors evolve, staying proactive and informed can help individuals and families make better financial decisions and navigate potential challenges in the housing market.
Today, let's dive into Canadian Mortgage Professional's latest report, revealing Canada's top mortgage lenders for 2025. This report is based on comprehensive feedback from brokers nationwide, evaluating lenders on product quality and service consistency. Janine, what stands out to you about this survey?
Steve, what really catches my attention is how the survey highlights broker priorities. It's fascinating to see that brokers were asked to rate lenders on a 5-point scale, focusing on both product performance and the level of support lenders provide to brokers. This dual focus on quality and support is crucial, especially in a market where client needs are constantly evolving.
Absolutely, Janine. The survey's methodical approach gives us a clear picture of which lenders are excelling in different lending segments, including fixed rate and variable rate mortgages, commercial loans, and refinancing options. It's interesting to see how these lenders adapt their offerings to meet diverse client needs.
And it's not just about the products, Steve. The survey also asked brokers to identify the factors most relevant to clients when choosing mortgage solutions. Understanding these factors is essential for lenders to tailor their services effectively. It's about more than just numbers. It's about meeting the real-life needs of clients.
You're right, Janine. It's also noteworthy that the survey highlights areas where demand is expected to rise over the next year. This kind of insight is invaluable for lenders looking to position themselves strategically in the market. It's all about anticipating client needs and being ready to deliver.
Exactly, Steve. And for anyone interested in the specifics, the full list of featured lenders and their rated products is available in the 2025 edition of the 5-Star Mortgage Products Special Report. It's a great resource for anyone looking to understand the current landscape of mortgage lending in Canada.
As we transition into the summer season, many Canadians are looking forward to spending time at their cottages. However, recent reports indicate that economic uncertainty and tariffs are casting a shadow over the cottage housing market. Janine, what's your take on this situation?
Steve, it's clear that the economic climate is affecting people's confidence in the cottage market. According to a report by Re/Max Canada, a significant portion of potential buyers are hesitant due to ongoing trade tensions between the United States and Canada. This uncertainty is leading many to pause their plans to buy vacation homes.
That's right, Janine. The report highlights that 59% of individuals whose housing decisions are influenced by tariffs feel less confident in the recreational market compared to last year. Despite lower borrowing costs and improved affordability in the past, the current economic situation seems to be impacting buyer sentiment.
Exactly, Steve. Don Kotick, the president of Re/Max Canada, mentioned that while market conditions have taken a hit due to trade discussions, there's still an underlying desire for secondary homes. Buyers are just waiting for more stability before making decisions. It's a temporary pause rather than a complete withdrawal from the market.
It's interesting to note that while unit sales in Canada's recreational markets aren't expected to decline year over year, the activity is projected to either remain flat or see a modest increase. Re/Max brokers and agents forecast a national average price rise of about 1.8% for the recreational market in 2025, which suggests some resilience despite the challenges.
Yes, and in Ontario, the cottage market is described as more or less paused, with both buyers and sellers closely monitoring economic indicators. Some regions have seen price declines due to increased inventory, while others are experiencing price hikes due to tight inventory levels. It's a mixed picture across the province.
And while some areas are feeling the pinch, others like Muskoka remain relatively insulated. Carrie Lysenko from Zoocasa pointed out that Muskoka benefits from a different buyer profile, often involving higher net worth individuals seeking investment properties. This could mean that while some markets are cautious, others remain buoyant.
That's a good point, Steve. The report also suggests that as Canadians reconsider their U.S. real estate investments due to tariffs, there might be increased interest in domestic vacation properties. This could potentially put more pressure on popular destinations within Canada, making them even more desirable.
It seems there's a silver lining amidst the uncertainty. With potential buyers diverting their attention back to Canada, it could lead to a resurgence in local cottage markets. However, affordability remains a critical factor, as highlighted by the Re/Max report, with a majority of respondents indicating it's a must-have.
Absolutely, Steve. Affordability and economic conditions are key determinants in the decision-making process for buyers. While the current climate presents challenges, there's hope that the market will stabilize and offer opportunities for those looking to invest in recreational properties.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, Their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.